have Feroze Azeez, Deputy CEO at Anand Rathi Wealth, right here in our studios to discuss that and lots more. Good to have you. And second largest NBFC in terms of its net worth, Reliance Jio. Do you think that still, when it comes to its business model, that there is a little bit of ambiguity? What's the view?
So if you're going to be demerging a business and then trying to build a financial services business from the scratch, there is going to be ambiguity. If you look at it from a long-term standpoint, you have to understand that it is going to be the most cash-rich NBFC. If 6% of RIL is there, that's a lakh crore. We're speaking of 1,35,000 crores of market cap, right? So there are 3-4 businesses in the financial services industry which will surely be a part of that business. One is the asset management business, which they have done an announcement for. If you look at the asset management business, now I'm only touching upon the long term, the short term and the volatility I'll come to. If you look at the asset management business in India is at a very nascent stage. Because out of the total financial services industry or the financial savings of the households, we are just about 6% in equity mutual fund. And if digital is their way to go, and that's why they've tied up with BlackRock, and you would have read about Aladdin, which is one of the BlackRock's digital platform, which has the potential to expand the entire universe of the asset management business. And BlackRock is a great partner because that's the largest with $10 trillion of assets under management. BlackRock has come into India and not been able to take over the entire 100% stake with DSP, and it comes back. So point one I'm making is, if you're looking at digitally reaching the asset management business to the corners of India, that's a business which will definitely be worth a lot more. Today you have a few asset management companies which are listed anywhere between 30-40,000 crores of market cap is what I would say. So from a long-term standpoint, the NBFC business will also be a very, very important business because that's a backward integration to a retail business from a lending standpoint. So long-term, these three businesses, asset management, liabilities and assets could be a very, very fruitful mix for a conglomerate like that.
What does that mean for you? Because when Reliance enters something, they will have their own weight, reach, scale, size, and the first thing they may attack could be the distribution channels. Lending business you can't disturb. Why? Because your cost of borrowing would be in and around the government paper. But distribution business is something they can attack. Wealth management business, mutual fund distribution, insurance distribution. What does it mean for the industry per se?
See, I think they may not attack the distribution business. Okay. The reason being, distribution, manufacturing is a far more attractive business at that scale. Okay. Distribution B2C is a very, very different business, right? It's not as lucrative for a long-term, large conglomerate like that. If you're going to manufacturing as a business, like index funds, like Vanguard is the second largest asset management company, right? Cost wars there become very, very easy to play because you have to manage a product, not several relationships. If you're going to manage 10 lakh crores in B2C, the kind of bandwidth it consumes is far, far different than a manufacturing. You have 10 products, you play a cost war, build scale and disrupt the business. Even in the NBFC business, it's possible to disrupt because cost war is the first strategy which generally this conglomerate generally adopts, right? You can have very low NIM aspirations, disrupt the market because the NIM aspirations of the rest of the NBFCs are very, very steep. In spite of the borrowing cost, if as an NBFC, as a competitor, if my aspiration is to have a 4% NIM and if somebody is okay with a 1.5% NIM for the first 5 years of the formative business, I think it can really, really have, and it's a commoditized business. So if somebody is going to lend to me on a consumer durable at 9, that's more attractive than 9.5. So it's a very easy, non-relationship, commoditized business you can disrupt.
So you don't think there could be a price war and nothing would change, let's say, for a IFL 360 or for that matter Anand Rathi or for that matter Prudence, I mean the three companies which are listed, you think nothing will change? Because the minute you think about Reliance, it just reminds you of the Jio moment. And that is what markets are worried about. That is what the stocks are also capturing.
See, I'll tell you, these are not the players which are Reliance, which we, like if you mention Anand Rathi, that's a compliment that we will fight them. Definitely not, right? As an NBFC, okay, you're looking at Bajaj Finserv, those kind of large book sizes kind of NBFCs who are in the actual granular lending in the Bharat, not in India, right? Okay. And Anand Rathi has presence in 11 different businesses and their aspiration of NIM of my sister company is 1.2%. So we are anyways not paying the NBFC game. So I personally think that will actually expand the universe more from the asset management standpoint. Asset management standpoint, it's a great news. Not just to...
great news for
all the
investors,
other asset management.
not shareholders.
Asset management companies.
Even for shareholders?
How's that?
Okay, let me try and answer that because it'll take me some time to articulate the theory and the hypothesis. Why is it a great news? Because when you're looking at expansion of the pie, in the alpha management, no new client will only buy a BlackRock Geo fund, right? When you expand in the pie in the alpha business, that's the alpha business. Asset management companies are in the alpha business. Wealth managers are in the beta business, managing risk, right? Doing asset allocation. Alpha business, if let's assume I bring a new client from one small little city in East India, right? That guy is not going to forever just look at Geo BlackRock funds, right? But I brought a new investor who will generally have 6 funds in his portfolio. As in his investing journey of 30 years, he might have tasted at least the top 10 asset management companies. So if SBI has about 7-8 lakh crores with about 16-17% market share and HDFC is the second large, if you bring in 3 crores new investors by the digital footprint of this partnership, then the 3 crore investors are going to be there for 10-20 years and they're not going to just buy the fund which actually got them to the platform. And if you look at Aladdin, which is the digital platform, stands for Asset Liability Debt Derivative Network. So it's not a very closed network if you look at what BlackRock has to offer globally.
They're creating an ecosystem broadly, and that's what Feroze seems to be indicating. Okay, my next question is that will investing in India change when such large platforms they take a birth, because they would be about size, they would be about reach, and they would be about low ticket size as well as low charge. And typically that means that index funds, which in India are not as popular as what they are globally, actually could become the port of choice. I mean, the first step never starts in index fund. It normally starts because your distributor, in a sense, nudges you to buy a small cap fund or a mid cap fund or even a equity diversified scheme. Could this change the needle towards index funds, which in India, by the way, is not that popular?
Nikunj bhai, what I personally think is, index fund investing is very good for a debt kind of an alternative.
Okay.
If you look at 384 active funds in India, the range of return every year they throw up.
They're very precise, 384.
Yeah, that was the last number, which I, March 31st number, I think so. 384 active funds. If you leave those sector funds and all that, you still have about 179 active funds diversified, fully diversified across sectors. The range of returns they throw up and the cost as a proportion of the range of returns is abysmal. Let's assume I go into an index fund and save a percent. But if the outcome is so different, 38% is the average difference between the best and the worst fund.
38% is the average difference in an equity diversified scheme.
Correct.
In a year.
Specific year.
No.
That's I'll tell you. This is the 4-year data.
Okay.
Last 20-year data is about 27, 28.
So just to break it for viewers, what your data is showing, and very interesting, that in a year, a scheme has given X return, that's a top performer, and the worst scheme in that year will have a gap of 35%.
Yeah.
You need distributors, man.
Absolutely. So in that, if the outcomes could be life or death, I'm not going to go to my neighboring doctor, right? If it is cough and cold, I'll just see who's the closest. But if I'm going to get a bypass surgery, then if the outcomes are so diverse, then cost is immaterial. But in debt, the best and the worst could have 1.5% difference.
Yes.
2% difference. There I'm paying 1% for the best fund manager, giving away half the potential fully. So I personally think if you can apply more mind and choice of funds, the value of that 0.5%, 1% would be very easily recovered. Can it be done by all distributors? The answer is no. I analyzed 700 external distributors' portfolios and 70% of them didn't beat Nifty. So should they actually get into an index fund? Yes. Maybe
70% of the distributors have not managed to beat the Nifty. That's your data.
700 portfolios which I analyzed, which are with external distributors. If I analyze transaction by transaction, every client does 50, 100 transactions. If they did those transactions in Nifty, would they be richer? They were richer. About 68% of them were richer. So index fund, I can't shun them because everybody is not putting in that kind of energy to identify the 384. Which out of those 384 I mean?
See, in the world of data, like they say, it's only when you look at the data you understand.
Anything can be proven best and worst.
Oil is the data is the new oil. Now I realize that what data is relevant. Okay, I'll be very specific here because this is a question which keeps on popping up now, and that's about small cap funds now, the risk reward ratio. There are two MCs who've decided not to take lump sum
Fresh money
into small cap funds. I think Nippon is one, and Tata AIG is one, the other one, right?
I think
My
that's
question
it.
to you is that for anybody who's watching the show, the temptation is to buy small cap is real, because small can become medium, medium can become big, big can become large. But purely from an risk reward ratio, do you think one should avoid buying into small cap funds, or it is still worth the bet?
See, I think the 2 points to that. See, small cap becoming mid cap becoming large cap. This hypothesis was true 10 years back, will be true 10 years from now. So you don't buy or sell stuff on a hypothesis which is a continual variable, right? 10 saal baad bhi I can make this statement that small cap will become mid cap. So that motivation for me to buy today can't be that hypothesis. But if you look at I have data till Jan 31st, pardon me. Of course, there's been outperformance of the small cap post that, is why I'm giving you my disclaimer. The underperformance with Nifty of the Nifty Small Cap 250 index, which is what is most relevant for a mutual fund investor, has been 5% per annum, 5.28 if I remember.
Can you explain that for us? Because it's an important point for our viewers. I mean, there's a frenzy in small cap stocks again and again. So what's your data saying?
January 31st, 5 years back.
Okay.
If you bought Nifty or Nifty Small Cap 250, Nifty Small Cap 250 would have left you poorer for 5 years of investing by 5% an annum.
And you're taking a high risk also, because when you're buying small cap, the volatility tends to be higher.
Absolutely. The beta is definitely higher in the small cap relative to Nifty. But the good news is when the rear view mirror shows ugly is when you should muster courage to buy it. So we increased our small cap exposure from an implied 16% to almost about 30% in Jan. Because if the rear view mirror is showing underperformance, can small cap underperform for 10 years? The answer is no. So that's one. And every time in the past this has happened over the last 10 years, that Nifty has outperformed small cap for 5 years. The subsequent 3 years for small cap has been outperforming periods.
Okay, so where is the rear view mirror ugly right now?
Mid caps, it's ugly.
Ugly?
Mid
Index
caps.
all-time high पर
lifetime
है.
high.
Index all-time high पर है.
No. Rear view mirror, you said. Sorry. The front view mirror is uglier for the 150 stocks.
Okay.
See, from a mutual fund investor, the top 100 is large cap, the subsequent 150 is mid cap. If you look at each individual stock and look at their businesses and look at Bloomberg analyst estimates and try and see what's the forward price targets, of course with some degree of more science, is a 12% target. Nifty is at 15. Small cap index is at 20%. So still there is a lot of relative outperformance on small cap possible, but the mid cap as a space can't be said in the same breath. Most of us generally say mid and small cap in the same sentence, but they're two very, very diverse groups. And small cap, the largest small cap is now about 17,000 crores. 5 years back, it was just 8,200 crores. So small cap as an English word is hiding more than it's saying, because it was small cap, called small cap then, it's called small cap now, but 17,000 crore business is being called small cap. It's something which hit me harder when I was actually doing the math.
So you're saying be wary of mid caps.
Yes, the 150 stocks from a mutual fund investor.
So I'll wrap it up, and I don't want to get this one wrong. You are of the view that right now, if one is looking at small cap stocks, they have not reached Humpty Dumpty. One can still invest in them. Mid caps have reached Humpty Dumpty, and when it comes to large cap stocks, they're fit and fine.
Yeah, absolutely. One small little point: in small cap, never do index fund investing. Because small cap is all about eliminating those businesses which could be tricky. People generally buy an index, but the fund manager's relevance there is not to manage return, but to manage risk. So that's the only disclaimer I would like to put.
You live and learn so much of data, but so nice to have you. It's your
Sounds
first
more
time.
complicated than we thought it is, right?
Thankfully, that's what gives me a job.
Yeah, exactly.
Good to have you here in our studios, Feroze. We started off by talking about Geo Financial, and then we deviated to a lot of very interesting data points. So it's been interesting to learn your take and your views on the overall market as well.